There's a small notification from your brokerage account. You didn't clock in, answer emails, sit in traffic, or negotiate with anyone. A company you partially own simply sent you money for continuing to exist. Not just the money, the psychology of the money. But then another voice enters the conversation. Usually calmer, usually slightly smug. The index fund investor. The person who says you are making this far too complicated. Stop chasing yield. Stop building spreadsheets around quarterly payouts. Just buy the market. Own everything. Sit still for 30 years. That's their argument. No stock picking. No yield hunting. No obsession over dividend aristocrats or payout ratios, which creates the real question underneath this entire debate. Everyone would simply maximize expected returns and become wealthy eventually. But human beings don't experience money mathematically. They experience it emotionally. Through fear, through impatience, through envy, through the quiet panic that shows up during market crashes, when your portfolio suddenly looks like a demolition site. Because both approaches work on paper. One strategy pays you constantly and reassures your nervous system along the way. So let's slow this down and look carefully at what's actually happening underneath both strategies. Because most investors never really understand the trade-offs. They just inherit opinions from Reddit threads, finance books, or whichever YouTube channel they watched first at 2 o'clock in the morning while panicking about retirement. And once you actually understand how these systems behave over long periods of time, something interesting happens. The conversation stops being about which strategy is objectively superior and starts becoming about which psychological structure gives you the highest probability of staying invested long enough for compounding to matter. And that distinction changes everything. Let's begin with dividend investing because emotionally, it's the easier concept to understand. If the business earns profits, management has choices. They can reinvest those profits back into growth, buy competitors, develop new products, reduce debt, repurchase shares, or return some of the profits directly to shareholders as dividends. Coca-Cola does not need to reinvent civilization every quarter. Neither does Procter Gamble. They sell products people already buy constantly: toothpaste, soap, soda, paper towels. Massive stable businesses generating rivers of cash every year. And if you own the stock, some of that money lands in your account automatically. That's the basic mechanism. But emotionally, dividends create something much bigger than cash flow. They create visible progress. Most investors struggle because investing feels abstract for years. You work, save money, invest into a retirement account, and then stare at fluctuating numbers on a screen while hoping future you eventually benefits. It requires faith. Dividends partially solve that emotional problem because the portfolio begins behaving like an asset you can physically experience in the present. You see deposits arrive, quarterly, monthly, sometimes weekly if you structure things aggressively enough. That feedback loop matters psychologically more than most financial textbooks admit. Humans stay motivated when systems reward them visibly. Now, historically, certain dividend-paying companies have developed almost mythical reputations among investors, and Procter & Gamble have paid and increased dividends for decades across recessions, inflationary periods, wars, housing crashes, oil shocks, political instability, and pandemics. But this is where nuance becomes important, because dividends are not magic. When a company pays a dividend, the value of the company decreases by approximately the amount distributed. The company is now theoretically worth $96 billion. The dividend didn't create value out of thin air. It transferred value from inside the company into your account. That distinction matters because many beginner investors imagine dividends as some separate bonus layer of return, when in reality they are simply one component of total return. A stock can appreciate in price. It can distribute dividends. Imagine two retirees during a brutal market crash. One owns a diversified dividend portfolio, generating enough cash flow to cover most living expenses. The other owns index funds and must sell shares each month to create income. Now imagine the market falls 35%. There's emotional stability there. Even if mathematically the long-term plan remains sound, psychologically it feels horrifying. Selling shares during a crash feels like dismantling your future in real time. This is where sequence of returns risk enters the conversation. Sequence risk is one of the most important retirement concepts almost nobody discusses until it's too late. If you retire shortly before a major market decline and simultaneously begin withdrawing money from your investments, the combination can permanently damage the sustainability of your portfolio. Early losses matter disproportionately because the account has less capital remaining to participate in future recoveries. Because emotionally and practically, reliable cash flow reduces the need to sell assets during vulnerable periods. Dividend investors understand this instinctively, even if they can't always articulate the mathematical framework behind it. But dividend investing has weaknesses too, real ones. High-quantity dividend portfolios often cluster heavily around specific sectors: consumer staples, utilities, financials, telecommunications, energy, real estate investment trusts. But stability comes with trade-offs. Many high-growth technology companies historically paid little or no dividends because they reinvested profits aggressively back into expansion. Then there's the yield trap, one of the most dangerous psychological mistakes in income investing. Humans are naturally attracted to larger numbers. A stock yielding 9% looks far more exciting than one yielding 3%, but markets are rarely giving away free lunches. Extremely high yields often signal distress. The stock price may have collapsed because the company's underlying business is deteriorating. In many taxable accounts, dividends create ongoing tax obligations, even if you reinvest the payments immediately. That reduces compounding efficiency compared to tax-efficient index strategies that allow gains to remain largely unrealized for long periods. Over decades, small tax frictions compound into meaningful differences, and compounding is brutally sensitive to friction. Tiny inefficiencies repeated consistently over 30 years become enormous gaps eventually. Now let's shift to index funds because philosophically they represent almost the opposite worldview. Index investing appeals to people who accept something psychologically uncomfortable but statistically powerful: the admission that consistently beating the market is extremely difficult, even for professionals. Instead of trying to identify future winners, index investors simply buy the entire market itself. Yet historically, simplicity has often beaten complexity in investing precisely because complexity increases the probability of human error. The modern index movement traces largely back to John Bogle, but Bogle understood something deeper about investing mathematics. If markets are reasonably efficient most of the time, and professional managers collectively are the market, then after fees, taxes, and trading costs, most active participants must mathematically underperform average market returns. Many actively managed funds fail to outperform simple index funds over long periods once costs were included. Fees matter enormously because they compound negatively. Low-cost index funds reduced that friction dramatically. Some broad market funds today charge expense ratios so small they're almost invisible. That matters because whatever money doesn't leave the system through fees remains compounding for you instead. Diversification became another major advantage. You instantly own exposure to hundreds or thousands of companies across multiple industries. One company, failing, becomes largely irrelevant. Innovation itself becomes your investment strategy because successful businesses naturally grow into larger positions within the index over time, while weaker companies shrink or disappear. That's an incredibly elegant mechanism. No visible reward system beyond account balances fluctuating constantly. During bull markets, this simplicity feels brilliant. During crashes, it feels emotionally brutal, because when markets decline sharply, no sense of productive income generation. Just falling asset values and headlines predicting economic collapse. Staying invested through those periods requires tremendous emotional discipline, much more than most people expect beforehand. And here's the hidden truth behind successful long-term investing. Investors rarely fail because they chose a strategy with slightly lower expected returns. They fail because they panic. They abandon boring systems for exciting narratives. Human behavior destroys more wealth than bad market returns ever will, which is why the dividend versus index debate often misses the real point entirely. The correct question is not which strategy wins every spreadsheet simulation. The correct question is which structure best aligns with your emotional wiring so you remain invested continuously across decades of uncertainty. Now let's talk retirement, because this is where the emotional differences between these strategies become most visible. One built primarily around dividend income, the other around total return index investing using systematic withdrawals. On paper, both strategies may be financially viable, but lived experience matters. The dividend retiree experiences retirement as incoming cash flow. The index retiree experiences retirement partly as asset liquidation. Those feel fundamentally different psychologically, even if mathematically both approaches can work. Humans are narrative-driven creatures. Selling shares feels like depletion to many people. Receiving dividends feels like production. That emotional distinction shapes behavior under stress. The famous 4% rule emerged partly to address this problem. Based on historical market data, researchers concluded that retirees withdrawing roughly 4% annually from diversified portfolios historically had a high probability of sustaining wealth across 30-year retirements. The framework works mathematically under many historical scenarios, but emotionally, watching portfolio balances decline during downturns while continuing withdrawals feels terrifying for many retirees, even when the strategy remains statistically sound. That fear causes behavioral mistakes. People reduce spending drastically, abandon equities permanently after crashes, or hoard cash during recoveries, all of which can undermine long-term outcome. If receiving dividend income helps someone remain invested calmly during market chaos, that psychological advantage has real value. Sometimes the best portfolio is not the theoretically optimal one. It's the one you can emotionally survive. At the same time, pure dividend strategies can become dangerously rigid. Investors sometimes refuse to sell appreciated assets, even when diversification would improve outcomes because psychologically they become attached to income streams. Others chase unsustainably high yields to artificially inflate retirement income, exposing themselves to massive capital risk. Every strategy contains behavioral traps. Index investors risk panic selling. Dividend investors risk yield obsession and concentration. The enemy is rarely the strategy itself. The enemy is unmanaged psychology interacting with money over long periods. The honest answer is frustratingly unexciting. Both approaches can work extraordinarily well if implemented intelligently and maintained consistently over decades. A globally diversified low-cost index strategy historically offers extremely compelling long-term total return potential. Dividend strategies offer psychological reinforcement and income stability that many investors genuinely value, especially near or during retirement. And increasingly, many sophisticated investors combine elements of both: broad market exposure for growth, dividend-producing assets for behavioral stability and income planning. Not ideology, functionality, because eventually you realize investing is not a competition to discover the single perfect strategy. It's an exercise in building a financial system durable enough to survive your own emotions for 30 or 40 years. The market does not care how intellectually correct your strategy sounds if fear causes you to abandon it during the next recession. Wealth is rarely built through brilliance alone. More often it's built through consistency sustained longer than other people are psychologically willing to remain consistent. And maybe that's the deeper lesson underneath this entire debate. The investor who quietly buys index funds every month for 30 years without interruption is not boring. They are emotionally disciplined. The retiree living partially off reliable dividend income during market crashes is not unsophisticated. They understand their own psychology well enough to structure around it. Both approaches can create extraordinary financial outcomes. The real danger isn't choosing dividends or index funds. The real danger is spending 20 years searching for certainty instead of allowing compounding enough uninterrupted time to work. Because compounding does not care whether your returns arrive through dividends, capital appreciation, or total market exposure. It cares about duration, consistency, time left uninterrupted. And the investors who eventually achieve real financial independence are usually not the people who found perfect strategies. They're the people who found sustainable behavior.